Hello, welcome to Wealth FX, and I am your host, Mr. Babs, convener of Man of Valor. And today I'm going to be teaching you a very important concept in the Forex market trading, which is how to trade price action like the banks. Yeah. Now, first of all, most people might say, what is price action? Now, price action is basically a unique technique that allows traders to place accurate trades based on previous and current price movements. Now, simply put, it is basically your ability to, pick the best trades or pick the high reward trades without having to use too many complicated concepts like indicators. You're basically focusing on what you can see on your chart. What is the price doing on the chart? And now, when it comes to trading price action, there are a few things or a few factors you want to consider. And those factors are: the first one is your candlesticks, the second one is the trend of the market, the third one is market structure, the fourth one is chart patterns. And the fifth one, which encompasses all others, is what I call top to down analysis. Now, we're going to be talking about them a bit deeper as we go further. Now, first of all, starting with candlesticks. What are candlesticks? Candlesticks literally gives you a whole lot of information about what a particular price chart is doing within a certain time frame. Now, when you go to your chart, of course, every candlestick is being measured by the time frame which it is formed. So let's say I am on a daily time frame, for instance, that tells me that if I have, let's say I have this candle on my daily time frame, what that tells me is it will take um 1 day for this long red candle to form. Now, the beautiful thing about it is the same candle, the same chart that literally used a whole day to sell all these bullish engulfing candle, literally did less than 10% of that same candle within 2 days. So this tells me that, of course, there are a whole lot of selling strength in this market than bullish strength. Now, the same goes for the overview, which is the other side, which is the bullish engulfing pattern. Now, for instance, if I see such a candle, what this tells me is if this was a daily time frame, within 1 day, price literally closed above the open price. So that tells me that there's a whole lot of buying or bullish interest and strength in the market. Without wasting too much time, okay, let's move further. Now, after candlesticks, what is that thing you want to consider? Now, of course, there are different types of candlesticks, and the ones that I have noticed to give me the best results are what I call the hammer and the shooting star for the single candlesticks pattern. Now, if you watch my previous videos, you would have heard me talk about the numerical candlesticks. Now, numerical candlesticks are candlesticks classification based on the number of candles in that formation. Now, for the single candles, we have the hammer, the shooting star, the pin bar candle. And now, when we go to the double candles, we have the engulfing candle, both the bullish and the bearish. And now, when we go to the triple candlesticks pattern, we have the morning star and the evening star. Now, these candles have been seen or have been discovered to generate the best sets of results when it comes to trading for profit. All right, moving on, just like I just mentioned, we have the evening star candle. And now, the evening star candle, which is the bearish version, you have a long candle. You have a long candle. You have a long candle, and then you have a small break of momentum, followed by a huge engulfing candle that swallows the previous candles. Now, the opposite is true for the morning star, which happens to be the bullish version. So the evening star is the bearish version, while the morning star is the bullish version. So yes, for the morning star, which is the bullish version, we had you have a red candle indicating a drop in price or a sell pressure, followed by a bit of a slowdown of momentum, and then a reversal of that whole pressure that nearly covers the two candles, or sometimes even covers it eventually. So yes, that's for the morning star. And moving on, we also have the up factors to consider, under factors to consider. Now we're talking about the trends. Now the beautiful thing about the trends is for every market direction that we discover or that we observe in the market, there's what we call the higher highs and the higher lows. Now the more you continue to notice that price keep breaking into new highs, and then making new lower higher lows, that tells you that you are in an uptrend, and such markets you're going to keep seeing a longer impulsive bullish move rather than the small repulsive bearish move. So when you notice that the market is giving you longer legs than what the pullback actually is. That tells you that you are in an uptrend. And yes, if you want to trade this particular market or chart, you want to pay attention to trading in the direction of the trend. Now, why do we trade in the direction of the trend? We trade in the direction of the trend because trading in direction of the trend tends to give you a little bit of more room for profit movement, because the impulsive move for any chart trend would always be stronger than the pullback. So yes, if I am trading with the trend, I have room for more profit taking rather than if I'm trading against the trend. Now, if I'm trading with the trend as well, because of the momentum of that trend, it is expected that I will cover a larger distance or larger price movement in a shorter amount of time. Now you notice the pullbacks, you have a whole lot of candles just within a particular zone. They are not really breaking out and they're not breaking below. Price just keeps maintaining that area. Now that's a range. Now, if I'm trading against the trend, I'll be caught in the range. And sometimes it just gives me, little profits before it trickles you out. But if you are trading in the direction of the trend, once you're on the right side of the trend and you don't get liquidated by maybe stop loss hunts, you most likely have room to catch larger profits. And now that would be for the uptrend. And the opposite is true for the downtrend, because the downtrend now is, rather than having higher highs and higher lows, what we have on the downtrend is, as price continues to progress lower, and then it pulls back, and then it drops again, pulls back, drops again, pulls back, and continue, and that keeps going on and on until that trend is reversed. Now, when you notice a characteristics of lower highs and lower lows, where you have the recent high and then you have a new low. Now, price happens to break the low, forming a new lower low. And as it tries to pull back, it does not come back into that same area where it left off. So now what happens? You have a lower high, and then price sells again, breaking new lows into lower lows. And then as it pulls back, it continues like that. This tells you that that particular market is in a downtrend. Yes. Now, moving further, yeah, we have market structure. Now, market structure is basically um the pictorial representation. When I say pictorial, I mean the picture representation of what the chart in combination of multiple candles are doing. Now, what do I mean? If I'm in an uptrend, for instance, just like we've been saying, if I am in an uptrend, I don't expect price to break the previous low for any reason. As long as price continues to stay above the low, that tells me that that trend is still in an uptrend. Now, The moment price for any reason decides to break a structure, retest, and then breaks a new lower low. Now, this is no longer an uptrend. Instead, price has shifted from an uptrend into a downtrend. So understanding these areas where there could be possible reaction or possible resistance gives you higher precision ability for your trades. So yes, the kind of market structures I do pay attention to or focus on most times is my supply and demand zone. Now, before now, there's a common misconception that people tend to trade support and resistance. Now, over the years, I've discovered as much as yes, that might be true, it is not absolutely true because a lot of times what happens is there would always be a liquidity hunt or stop loss hunt around your support and resistance area. So most appropriately, I always advise that if you are paying attention to any structure in the market, you want to pay attention to the supply and demand zone because the supply and demand zones would always serve as potential zones for other positions. So if someone, let's say a particular price used to be very enticing, and then at that price, for some reason, markets decided to buy aggressively, and you notice there's a huge candle, maybe an engulfing candle somewhere around like this. Now it is expected that after much movement, the next time price comes back to that area, there's every possibility that that same zone would serve as a reversal for price to continue back into the highs. Because of course, if I bought, let's say I'm buying a commodity, for instance, and I bought it at 1,000, and for some reason, price happens to go up the way 3,000. I mean, the next time that commodity comes back to 1,000, there's every probability or possibility that I would want to buy more of that commodity, expecting that if it had gotten to 3,000 at some point, then there's every possibility that from that 1,000, it should approach 3,000 again or even higher. So yeah, that is how we use market structure. And yes, your demand is below your your demand is literally your last low, and meanwhile your supply is your last high. And yes, how do we identify these zones? I'm gonna talk about them in the chart on the charts shortly, because supply and demand can be tricky if you don't if you're not careful with using them. So yes, supply is just like I use for illustration purposes. Supply can be termed as your roof in a building structure. That's the highest point price got to, and then your demand can be your floor, that's your foundation, the lowest point price got to. Now, everything else that happens in between those areas are literally just, price play, like I call it. Yeah. So moving on, I've been able to talk about market structure. Let me see. Okay, moving on, we have chart patterns. Now, there are a whole lot of chart patterns, but for the sake of this class, I categorize them into two. And the first one I'm going to be talking about is reversal chart patterns. Now, for reversal charts patterns, what we discover is these are patterns that you observe in the market when the market is about to change direction. An example of that for reversal chart pattern, we have the bearish double top. And double top, what does that mean? What the double top means is it is basically where price rises to a particular point and you notice the first high, and then for some reason it finds its way back into that same region and immediately it breaks below the last low, forming a new break of structure. Now we have the head and shoulder pattern. Now, why this is actually the bearish version because you have the head, you have the left shoulder, and then you have the right shoulder. And the moment we see a break of structure, that tells us that yes, this trend is reversing from probably an uptrend into a new downtrend. Now we have the bearish rising wedge. Now, the bearish rising wedges, you just notice that for some reason, price keeps struggling to break out of the new highs as it tries to form higher lows and higher highs. Now, of course, it keeps forming higher lows and higher highs until at a certain point it breaks below the last low, closing below, telling us that yes, for some reason, price has reversed from being in an uptrend, and then we're looking to sell lower. And then we have bearish expanding triangle. Yes, this is also another reversal pattern. Price maintains a particular area and all of a sudden it breaks below the last low. Now, mind you, break of structure is very significant when it comes to taking reversal trades because this tells you when price has literally exhausted all of its initial momentum and is changing direction to continue going lower. Now we have the bearish triple top. Now, just like double top, this case, there are three. The first touch, the second touch, and then the third touch. Now, all of a sudden, the moment we notice there is a break of structure, yes, this tells us that this trend is about to continue lower. Now, for the flip side of these five chart patterns, for the flip side of that, what we have the bullish double bottom, we have the bullish inverted head and shoulder. Yes, upside down the head, the right shoulder, and then the left shoulder. And when we notice a break of structure around here, which is BOS, yeah, break of structure, and we're looking to continue the trend. Yes, we have the bullish falling wedge. Price seems to be falling, and all of a sudden, it breaks the last low, forming a new break of structure and continuing the trend higher. Yes, we have the bullish expanding triangle, which is opposite of the bearish expanding triangle. And of course, very important, we want to pay attention to the break of structure around that area. And yes, last but not the least, for reversal patterns, we have the bullish triple bottom. Just like the bullish triple top, you have the bottom one, bottom two, and then the bottom three. And the moment we notice a break of structure, we're looking to sell, to buy the commodity into the high prices. So yeah, moving on, I think this is for reversal patterns. Yes, these are some reversal patterns that has generated amazing results for me and my community over a certain period of time. Now we also have the um continuation patterns. Now continuation patterns are basically patterns that signifies the trend continuation. So just like the reversal pattern signifies the change in direction of the market, the continuation pattern signifies the follow up or follow through with the trend or the current market trend. Now, the first continuation pattern here is ascending triangle. Yes, it looks like the triangle keeps ascending and all of a sudden we have a break of structure above the high into new highs. Yes, we trade that, continuing the trade into the new direction. So we have a break of structure around this area and then continue the trade above. Now, most times I'm going to be showing you how I use this on my chart. Now, most times, you want to place your stops below structure and then target new highs. Now, we also have descending triangle. Descending triangle is all of a sudden, it looks like the triangle is falling towards the downside, but then price could not, reverse the last low, but instead it breaks below it. And then that tells us that the downtrend that has initially been ranging is about to continue lower. And yes, we wait for a break of structure and enter into the market, selling it to the downside. Yes, we have a flag, and this is one of my most favorite continuation patterns. I love flags when I see them because they always give you high rewards potential. And across any market, you can use a flag. So yeah, this is a bullish flag. You have the pole, and then you have the range in between this area. And when you see a break out of structure, we're looking to trade into the highs. And then we have a bearish flag, which is the opposite of a bullish flag. And yes, a bearish flag is literally a bearish version of the bullish flag. And you wait for a break below structure and we trade into the lows. Then we have a bearish rectangle. Price maintains equal highs and equal lows Of course, we want to wait for the break of structure into whatsoever direction and trade it lower. Then we have the bullish pennant. It looks like a scaffolding triangle, but what you want to pay attention to is how the price breaks out of the structure, and then you wait for an entry, set your stop loss below the structure, and trade into the new highs. We also have the bearish pennant, where it looks like, yes, it's a triangle, but not completely a triangle. And most importantly, for trend continuation and trend reversal patterns, generally, you want to pay attention to your break of the structure and then take the trend towards the downside. Also, we have the bullish wedge, which is what I have here. It's like you're resting a ladder against the floor, and most importantly, I tell people it's not just the patterns, it is where you see them. And it's not just about seeing them. You want to pay attention to the structure they are violating. So when a chart violates a particular structure, it tells you that yes, there's a momentum in that particular direction of that chart. Then you have the bearish wedge, which is the opposite of the bullish wedge. Yes, the bearish version, you most likely break of structure below and then you sell to the downside. And lastly, for chart patterns, we have bullish rectangle, and where price maintains equal highs and equal lows. And most importantly, like I always say, you want to pay attention to the break of structure, because after the break of structure, whatsoever direction the structure breaks into, there's going to be a whole lot of momentum towards that direction. So yeah, that's it for continuation um, patterns, because yes, chart patterns are very, 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 very important and helpful when trying to trade price action. So yeah, moving on, we have top-to-down analysis. Now, what do we mean by top-to-down analysis? Top-to-down analysis is basically our ability to correlate from the higher time frame to the lower time frame. Now, most people just, especially for scalpers, and they tend to focus on lower time frame, maybe hourly, and barely did they go up the 4 hours, because most times 4 hours charts are for swing traders. And yeah, swing traders are more of trend traders. We trade the trend. So yeah, your ability to narrow down whatsoever information the chart is telling you or showing you, all the way from your higher time frame to the lower time frame, is very important. Because why? Price moves in what we call fractal patterns. Now, what are fractal patterns? Fractal patterns are basically whatsoever you see on the higher time frame can also be replicated on the lower time frame. So I can have an information on the monthly chart. I go to my weekly and I'll see the same thing. I'll go to my daily, I'll see the same thing. I'll go to my hourly, I'll see the same thing. Now, for best results, how do I use the top to down analysis? I'm going to be showing you one or two pairs on the live charts shortly. But now, how do I use my higher time frame correlation? Most times I start from my monthly or weekly charts, then to my daily, then to my 4 hours, and exhaustively I go to the 1 hour, where I want to wait for my entry setups before I take my trades. Now, the reason I use that is because I am a trend trader. I tend to focus or pay attention in trying to capture a larger percentage of the move as much or as best as possible. So yeah, you want to be able to interpret the information from the monthly time frame, because the monthly or weekly gives you a broader view of what the market is expected to do in a couple next few months or few weeks. Now, if you understand what the market is supposed to do in the couple weeks, you should be able to know how to navigate that weekly time frame into your daily chart, such that you have multiple daily trading opportunities even as you look forward towards the weekly picture or the monthly picture. So yes, our ability to correlate from the higher time frame towards the lower time frame gives you more precision, more accuracy, and more profits in the long run. So yeah, having said that, let's quickly go to the live chat. Let's do some live analysis, and yeah. So this is I'll be showing you my trading view. This is my trading view, and currently the chart on my screen is the XAU USD, which is gold, and that happens to be one of the most interesting pairs I love. So, but for the sake of what we talked about, so far. I'm going to be showing you how I do my analysis, my price action trading analysis, and then I take it from the higher time frame. I have to do my top to down analysis, which is very important because this gives you a broader picture of what the market is expected to do or what the market is looking like it has been doing or it will continue to do. Without wasting too much time, yeah, so just like I said, this is the monthly charts now, for instance. What this tells you is for every candle you see here, for every candle you see on this monthly chart, it literally took one whole month, 30 days, 31 days, 4 weeks or thereabout to form itself. Now, why this is important is within a certain range. I expect that okay, for the next few months, this is what I am looking to expect from the market. Now, from the monthly, I'll go down to my daily, okay, weekly. Now, on that 1 month, this is what I had. But now that same 1 month chart has been expanded into my weekly chart. And now what this tells me is, let's say a month of information on the monthly chart, that's literally about 4 or 5 weeks of movement on the weekly chart. So that 1 month of movement has literally been spread across about 4 or 5 weeks of price action movement. So yeah, having understood my weekly chart, what the structure looks like, because currently this is gold. This tells me that price has been within this range, within the 3445 range, and the 3251 for a couple weeks now, struggling to break either above and struggling to break either below. Now, if you notice, there's a rejection of higher prices around this area, this long week, another week, followed by a bearish engulfing candle. Now, the next time price came into that zone, we're having a possible long tail and looking like a bearish candle close. Now, what do we want to see? This tells me that it is looking like for some reason this uptrend is exhausting and there's a possibility of bearish interest in the market. But now, not completely confirmed, I'll have to go to my 4 hour chart in order to expand it. So now the weekly chart, or no, let me do daily. I have to go to my daily first. So now my weekly chart has been spread across my daily chart. So 1 week on my weekly time frame is about 7 days. That's 7 candles on my daily time frame. So that same set of information, that same range which we saw just now, is what we have in all these multiple candles. Now see, there was rejection 1, 2, 3, and this is the fourth time price is rejecting that area. Now, what are we trying to see? We are noticing that there is equal or there's a balance between buyers and sellers within this particular range. None of them have completely been able to break the structure. So what that tells me is I want to wait for what direction price is breaking into. Are we continuing in an uptrend or are we looking to sell? Now, that's where I go down to my 4 hour chart and pay attention to what the chart is showing me. Now, paying attention to the daily chart, which I just expanded, what do we have? We have a little bit of bearish momentum breaking this structure into these lower highs. Now, could this be that price is beginning to reverse from all the uptrend momentum into a downtrend momentum? Well, you can't be too sure because there's every possibility that price could still respect the bullish momentum around this area and continue higher. So yes, we want to wait for a confirmation on the 4 hour that tells us that, okay, yes, now already I have a break of structure around this area. I have a close below the two moving averages, 20 and 50. I also have a push down. Now, what does this tell me? This tells me that there's every possibility that the bearish interest is increasing. So most likely, if I see a pullback to liquidate any possible supply zone, and then a close below candle, I expect price to continue in that direction of the trend. So what am I paying attention? There is a supply zone around this area. And yes, most likely what I will pay attention to is price coming back into this area, close below, maybe an engulfing candle or something. and then I trade it into the downside. So yeah, this is how I combine price action trading from candlesticks to trend to market structure, chart patterns, and top-down analysis. Yes, I don't want this video to be too long, but I do hope I have been able to do a bit of justice to price action trading. And yeah, I believe in subsequent videos we're gonna be diving deeper into some of these subjects, more intricately, so that way you have a detailed understanding of how to navigate them individually. But yeah, this is a combination or a chart sheet guide, a cheat sheet guide for how to use your price action. So yeah, first of all, you want to figure out what candlesticks are you looking to use before I go. So yeah, let me just do a recap. First of all, you want to pay attention to the candlesticks you are observing in the chart. On your top-down time frame analysis, starting from your higher time frame, what candlesticks can you find? What trend is the market in? What market structure are you paying attention to? What chart patterns are you looking out for? Is it a flag? Is it a double bottom? Is it head and shoulder? And things like that. And then adding all of them together, what confirmations do you have? Most times I use my candlesticks for my confirmations. So yes, when I see candlesticks around a significant zone of interest, it tells me a whole lot of information about what the market is looking to do anytime soon. So yeah, without wasting too much of our time, I do hope this has been a wonderful um, trading tutorial. And yes, this is Wealth FX, and yes, our focus is trading made easy. We want to simplify every trading concept as much as possible. So I do hope you found value in this video, and please like and subscribe. I look forward to seeing you in our next video. And for those of us that probably don't know us, this is Wealth FX, and yes, this is Trading Made Easy. Please like and subscribe to our YouTube channel, and we look forward to seeing you in our next video. Thank you, thank you, thank you, and yes, do have a lovely evening. I remain your host, Mr. Babs, and have a wonderful evening. Bless.